Hello and welcome to the stock specific class here for Thursday, March the 25th. So we did get a little bit of that downward sell-off in the market from the last update, but it does look like we're getting a little bit of a bullish reversal today. So we'll see. I don't see that as being very good as far as the getting the longer term trend continuing in a strong way. When you get these little minor sell-offs that rebound right away, it usually just leads to more whipsawing and stagnant conditions, just like we've seen for the last couple months. And yeah, I mean, the uptrend can continue, but what happens is it just, you're not making the same money as quickly as you did back when, the trend was really strong and taking on, when the buyers were really aggressive and the trend was taking off. A lot of times when you get a nice sharp sell-off, it creates enough fear in the market, not enough fear to where everyone panics, but enough fear to where people start to get really concerned. It can fuel that rapid buying when it ends, when it bottoms out, and you can get some. Well, not only do you get nice pullbacks on the stocks that you want to get into, but you also can get that rapid movement back up. So we'll see what happens. And another thing with these shallow dips is that you just know that there's a bigger one coming, and you almost kind of want to get it out of the way. And when it rebounds, you know that it could still be, a few weeks away. We could be moving sideways or choppy for a few more weeks. We'll look at the charts here, and I can kind of show you that. As far as the signals are concerned, we are seeing momentum dip quite a bit. We talked about this on Tuesday. It's been declining. The breadth has still been okay. It's in the high range. So it's been, you've been seeing higher highs, higher lows on breadth, which is that's a good, healthy sign. Change my pen color here. And then on sentiment, you're not in an extreme range. You're in a high range, but you're not in an extreme range in sentiment. So one thing that did change was the buy-sell ratios. If you watch this, we were right coming closer together on Tuesday. I said, we'll see if we start to sell off and see more of those stocks move from holds to sells. And that's what we're seeing right here, is that starting to spike up. You see that at any pullback, you'll start to see that take place. We're not in an extreme range yet, though, where we're really oversold, which means that, if this bullish reversal day today doesn't hold, there could be a lot further that we drop. That could become even more extreme. Let's look at the charts here real quick, and then we'll get into some specific stocks. By the way, the trading today is we're going to get into the covered call strategy, and this is a very safe way to be an options trader. And again, it's dealing with being an options seller. We just got done talking about selling puts to acquire stocks. And so we'll talk about how the covered call works, being a call option seller, and all that goes into that. All right, let's take a look at the chart of the SPY. Remember on Tuesday I was talking about how we had this drop on most of the indexes. We had this drop, and then we were kind of moving a little bit sideways. And the way that looked is it looked like we would probably have another move down. Now, where this comes from, well, I've talked about a number of things over the trainings we've done. Whenever you see a stock starting to move sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. That's something you hear me say all the time. But it's also how those ABC patterns form. You get that initial sell-off. It starts to rally a little bit. People think that that's the bottom, that's the dip to buy, and that's just the first move down. That's wave A. You get the little bounce, or sometimes it is just a sideways move, a little pause. That's your wave B, and then you get that next move down for wave C. Now we've got the bullish reversal day today, where we open lower, we traded a little bit lower and then we reversed it. Now we're higher than where we opened for the day. Now on some of the indexes we're still at least last time I checked, some of them were still negative, showing negative, but that's compared to yesterday's close. The fact that they've rallied from the open, from where they opened today, that's usually a bullish type price action. Okay. Now, another thing, the reason why I think this could be a bullish reversal here is that if this is an ABC pattern, one of the things you hear me talk about all the time is that very often your ABC pattern is complete when that wave C is about the same length as the wave A. And if that is an ABC, and again, the reason why I say possible ABC pattern or could be an ABC pattern is because we won't know for sure if that's an ABC pattern until the stock rallies and breaks out. And then you can look back on that and say, oh, yep, that was an ABC pattern. So we're always dealing with possible or could be, and that's why I use that language. There's no certainty in trading and no certainty in the markets. And so, you know, kind of the joke is that traders are the most non-committal people in the world. You know, they can't say something is exact, and it's true, they can't, because they've been through it too many times where something looked exact and then it ended up not working out. But there's a number of clues here. It's not just that one thing. It's the bullish reversal day. It's the fact that wave C is about the same length as wave A. You can even throw in it's retraced this move up about 50%. Remember, stocks will tend to retrace about 50% of their moves. It's retraced that last move about halfway. So there's a number of things that are pointing to this possibly being a bullish reversal where the market could start to move back up. And another thing that's important too, because you know you could say that I flip-flop a lot in my analysis, and you have to be a good flip-flopper if you're going to be a trend trader. What I was seeing on Tuesday in the charts and in the price action was different than what I'm seeing today. And it's hard to do that, to be able to flip from being bearish one day to being bullish. But that's why we really want to focus on the clues we're seeing, because they change. These things change. We could now, for instance, tomorrow, if this is a bullish reversal day, if tomorrow we're down here and heading lower on heavy volume, then I will completely shift my outlook to bearish. That's very bearish if that were to take place, and I've got to be able to flip that quickly to deal with that new information. Otherwise, you stay in trades. You stay in trades you should be getting out of because you're hoping it just reverses and goes back up, and you're not dealing. You're dealing with hope and not dealing with reality. And so. But so far, that's kind of what it's looking like. There is that we're getting a little bit of a bullish reversal right there. So we'll see if that continues. Now, what I was saying though is that, again, the problem with just some of these shallow pullbacks is that, well, here you had a quick one, but it was pretty shallow. It did make it back and break out, but as soon as it broke out again, look what happened. It moved sideways right after it broke out. This is a little bit of a deeper pullback, but still not a very big pullback here. When it rallied quickly back up, but as soon as it broke out, look what it did. It just moved flat, moved sideways, and then we're pulling back again. The thing I worry about is that the same thing will happen if we could rally back up to here, but once we get there, we just move sideways and just kind of keep. You can see that the trend direction here is starting to change, where it was nice and steady through here, and now when you're connecting the tops, look what's happening here. It's starting to flatten out, and this is a type of topping type behavior. What it's telling you is that the buyers are just not as confident that things are going to go much higher, and so when you get back to those all-time highs, they say, oh, great, we're back at all-time high. Maybe we're too high. Maybe that stock is too expensive now. And I talked about this on Tuesday, that we do this in our everyday lives as well. There's certain things that you buy that you know that it's an expensive price, and you wait for it to go on sale before you want to buy it. What we really need is a nice sharp sell-off. And I've been looking for one that's similar to what happened back in October. Go to a little bit longer term chart here. These ones right here were perfect. The September and October pullbacks, because they were deeper, but they weren't so big where they caused panic where people thought the end of the world was coming or something like that. They were deep enough to shake shake everything up a little bit, but not cause that panic. Now this one in September didn't lead to a big move higher. It did get back up, didn't even get back up to the previous high before you got this October pullback. So you kind of got two of them in a row. And then, but then that led to the aggressive buying it. You had the sharp pullback to break out, and then you had a nice sharper rally for the last several months here. Now what's happening here is we're starting to flatten out on that trend, and we're starting on some of the other indexes. We're starting to break to lower lows. I'll take a look at the QQQ chart and the Russell 2000 chart, which is very important because those are leadership. Those have been leadership stocks. So what I'd like to see is a much bigger pullback, maybe even back to this breakout area right here, and that would bring prices down to where valuations and things would be more attractive. Because what you're trying to attract, or what you want to attract, are the big institutional traders. They're the ones that move the market. I don't care what the Reddit crowd is doing, because they're not big enough to move entire markets. They might be able to move GameStop, one stock, and control it a little bit, but they're not going to be able to move the entire market. And so that's what's going to attract those big institutional traders, is when those valuations, or when the prices come down to a valuation that makes a little bit more sense to them, and they're going to be a little bit more aggressive in their buying. Let's take a look at the Dow chart. Hasn't broken yet. It's the one that's been kind of outperforming, and that's a sign too, because again, those big Dow stocks those are the larger companies. There's less risk with those. Those aren't going to go out of business overnight. And so whenever traders get concerned with market conditions, they tend to go into the larger companies, the more stable companies. The companies are paying higher dividends, where they may not get as much of a move in the stock, but they're going to get that dividend, or they're going to get that safer return. And so you tend to see that at the end of trends, where usually the Dow's the last to kind of break down. NASDAQ 100 right here, you can see it already broke its trend back in here. It's rallied back up to it. And again, I don't know if this is on its way lower. It's already gone to a lower low right there. That's why it not only broke the trend, but it broke that it went to a lower low. It is possible, though, that this is also an ABC right here, correcting this little move up, and that it has a little bit, it could make another attempt. I just don't think the QQQ chart is going to go to a new all-time high before we get a bigger correction. Again, that could change. I don't lock into any forecast I make. It's just the way it's behaving, and the way typically what happens when these indexes start to roll over. That's usually not going to go back up when the trend gets broken like that. It's usually not going to go back to a new all-time high right away. But now we're seeing the Russell 2000 chart break down, and there's your uptrend. You could even say that was a little bit of a break of that right there, but it did go back to a new all-time high. But here you have a clear break of that trend, and you're getting to a lower low right there. Now, we did have a bullish reversal day today as well. We can zoom in on that a little bit. But, it could be that this is just a little bit of a bounce. Maybe it rallies back up a little bit and then rolls over. So I'm really going to be watching the Russell 2000 over the next few days, because if it starts to look like it's going to roll over and drop again, it's probably going to lead the rest of the market down, just like it did right through here. It had the biggest move down percentage-wise on the sell-off over the last couple of days. and that's because those small cap stocks have been the leadership of the rally. All those electric vehicle stocks and things like that, SPACs, all that kind of stuff, the riskier type trades, people would piling into those, and then they start to get out of them. All right, so those are the conditions. Again, to sum it up, I would say the larger trend is probably in trouble a little bit with the breakdown of the NASDAQ 100 and the Russell 2000 charts. Near term, though, we have this bullish price action today, and so just keep that in mind. That if I were making a decision based on that analysis, I'd say, well, if I see something I really like going through these individual stocks, then I could probably get into maybe just one of them or something like that. I wouldn't get into a lot of different trades in this type of environment, just because the larger trend looks like it could be in trouble. But in the nearer term, if I really like a pattern, I could get into it. And then my trading plan would be more shorter term. I might plan on trading it just for a few days to see what this, see if we bounce off of these lows here. I should probably go back to those SPY chart, because it's a little bit better looking chart if you're being a little bit more bullish. But and who knows? We're not done with today. I mean, we could fade into the close. We could fade into the close. This goes all the way back down to the open, and that would still be pretty bearish. It would be a very bearish close if it were to do that. So that's another thing to kind of consider. All right, so let's get into some individual stocks. And I'm going to start off in the construction sector right here. We haven't seen, we haven't done too many construction trades lately, but here's what we did a while back and did really well for us. HOV here at the top, 97 strength rank. Now let's turn the signals on here. But we traded this back in, I think it was back in here. And kind of that bowl-shaped move right there. Now, we've stayed sideways for a long time. And I think we had another trade earlier this year off of this kind of bowl-shaped move, and this is where it really broke out. But you can see the context here. You can see the stair step. I'll point that out here in a second. Let's move the chart down. Had this burst of a move, and then it consolidated through here. Burst of a move. Here's a little bit of a pullback. Kind of burst of a move right here. Now it's had a little bit of a deeper pullback. Now you'd probably want to wait for that confirmation going back to the buy signal. This is very close to going back. In fact, any other up day. Today had a bullish reversal day, so we dropped right here, opened low right here. Here's where we're trading. So it looks like we're reversing that. We're very close to going back to a buy signal. But I might trade this with a shorter term outlook for a couple reasons. One, the market conditions I just went over, but also the stock has moved very sharply over a short period of time. Just since the beginning of the year, it went from a $30 stock to a $100 stock. So this, with a bullish reversal right here, what you're hoping for is that it gets back up to that previous high and maybe breaks out again, but you might be starting to get a little bit closer to a top. But there again, I could have thought the same way back here when it went from 30 to 50. We don't want to put limits on how far a stock could go, and that's not what I'm saying here. But what I also don't want to do is recognize that it has moved unusually for the last few months, where it's gone from a $30 stock to a $100 stock. That's an unusual move. And again, from a probability standpoint, the chance of this going from 100 to 200 over the next 3 or 4 months is probably not very high. So I might have just a little bit of a shorter expectation if I'm going to trade this. And I might be a little bit quicker to stop out or take profits or what have you if I start to see any sort of bearish reversal that starts to take place there. So But that's a nice looking trend, and looks like a nice little bullish reversal day today. Then let's go down. I don't have a ton today just because of those circumstances, those market circumstances, and there haven't been a lot of great patterns. A lot of stocks haven't had. They're either broken and they don't look attractive yet, or they look kind of stretched still, and I don't want to chase them right here. Computer and technology. By the way, I don't mind chasing stocks that are up if the market conditions look, really, really strong. But that's just the point. I want to chase something when the market conditions are looking iffy, and that's kind of where we're at right now, where we can kind of go either way. Computer and technology, there's a new one here that I can add. There's some of the other ones. Blink. Now, Blink went to a sell signal today with that open lower, but it has a bullish reversal today where it opened down here and it's trading up here. So it's showing that the stock is down a little over 1%, but the price action is suggesting this could be a little bit of a bullish reversal. So when I see you've had a sharp pullback right here, it started to move sharply up, and then this could be wave A, wave B, wave C. But you can see where when I talk about wave B being a sucker's rally, I've mentioned that a number of times. Sometimes the implication is that it's that everyone else is the sucker, right? Everyone else out there is the sucker. I recognize that wave B is a sucker's rally, so I never fall for that trick. Well, whenever we talk about the trading crowd or being part of the crowd, a lot of times we disassociate ourselves from the crowd. Like, we're smarter than everyone else. We never fall for those stupid little crowd behaviors. Well, the reality is we all do at times, and that's why they always work, is because it's part of human nature. And this looked like kind of a corrective pattern right here, and then you had a nice little kind of bullish move right there. That was on was that Monday? Monday had that bullish move right there. Tuesday we're down a little bit, but it looked like that was pretty high probability I was going to move up right from there. Well, it could be that was wave B. Now I still say it could be, because if this thing heads all the way down here, it's not. We're in a full blown downtrend, but that could be wave B. That could be that sucker's rally, and this could be wave C. You got a bullish reversal day, and maybe this thing starts to move back up. Now, ultimately, though, we still have to be aware that, and this goes back to the Elliott wave trading, that this could also be a larger bearish ABC pattern where that's wave A, this is wave B, and you get this rally up. You do get the rally up, but it ends up being that final wave C before getting a much bigger drop. But especially with that bullish reversal day today, there's a pretty good chance this thing is going to move up off of that. And but I just want to point that one out, because we did talk about this one on Tuesday. It does have a sell signal, so you could wait for it to go back to a buy signal as a stronger confirmation, which it's going to take a little while for it to go back to a buy signal. But I thought I'd kind of go through that with you a little bit to show you what kind of happened there. Let's go back to computer and technology and look at, like I said, a newer one, this AVNW. It's a 96 strength rank. But what I liked about this was it looked to kind of have an inverse head and shoulders type formation, which is a very bullish pattern. You had this nice little run up right here, and then it kind of consolidated into here. So there's kind of your left shoulder. It dipped down and came right back up. There's your head that formed, and then it's been moving a little bit more sideways right into here. There's kind of your right shoulder. There's your neckline right into here. Now, the reason why I love these patterns is that if they break out, you have a pretty nice target area that's it's kind of a rule of thumb. It doesn't mean it always does this, but it does it enough to where we can call it a rule of thumb. But if it breaks out of that neckline, so it breaks out above here, and you could say wait for it to go back to that buy signal, might be it has a little ways to go for that to happen. That would be good confirmation as well. But if it breaks out of that head and shoulders formation, the rule of thumb is that it will tend to go up about the same distance as the base of the head, or this breakout area right here, to the bottom of the head right here. So you take this distance, project that upward, and it gives you kind of a minimum target area. Now, stocks don't always go there. They can go short of that measurement. They can go beyond that measurement. And they could barely break out and reverse and fall apart. But it does it enough to where it becomes a nice way to help you stay in the trade. If you kind of have an idea of where you're expecting it to go, and that expectation is based off of a pretty high probability, then it's easier to stay in a trade off of these little dips, because it's not going to go straight there. It's going to kind of stair step its way there. And each time you get these little dips, it's a little bit easier to stay in the trade, knowing that it should get to that point. So that's kind of what I was seeing on that particular chart. All right, let's look at business services sector. Oh wait, there's one in the auto sector too. Let's go to the auto sector right here. And like this HZN, 93 strength rank, so it's a little bit lower strength rank. But here it broke out and it pulled back at a little bit more than, well, right about a 50% pullback from this move up. And then it had a nice little bullish reversal day today. And this one's probably pretty close to going back to a buy signal as well. Yeah, it's getting there pretty close. I do recognize though that if you start to connect the tops of some of these charts, you can see that it's starting to maybe flatten out a little bit. It was moving a little bit sharper back here. But if this does hold and it starts to move back up, it should break out. If the trend is still strong, it should go to another higher high. That should be a higher low right there. And so it should continue to move higher off of that. And then let's go into business services. And I'm looking at the 98 strength rank. It's Mogo Incorporated. And now I usually like to see a little bit more of a choppy back and forth move when it pulls back. These sharper moves, sometimes the danger in this is that could be, here you had your breakout higher. Whenever I see a sharp move down, that could be an indication of a trend reversal. And then maybe you get a rebound back up a little bit here, and then it rolls over and it drops further. Now, this is a kind of a bullish reversal day with opening lower, although it's faded a little bit recently here. It looked a little bit stronger before the class started, but it could be that you get a little bit of a bounce off of it. But there again, some of these you get a sharp pullback and it does end up going higher. You do have the higher high right here, possible higher low with that bullish reversal day. And if that does hold, it could possibly go all the way back and move higher there. But you do have to be aware, if this thing starts to rally off of this bullish reversal day, and then it starts to kind of stagnate, it moves up into this area here and starts to kind of move sideways, or it gives you a bearish reversal, there's a possibility that thing is rolling over and has further to drop. So that's one thing you'd have to kind of keep an eye on. But I like anything that is retraced 50% and has a bullish reversal, because in some cases, I could just trade. There's a high probability this is going to go up off of that, and if I can find something that goes up, even if it just goes up, in this case, even if this thing goes up just $1 move on an $8 stock is a pretty good percentage move. Even if I just trade that $1 move, that's a pretty nice percent gain off of just trading a bounce, even if it just bounces a little bit. All right, let's get to the trading for today. And the trading is going to be on covered calls. Now, I'm going to go over I'm going to go back to that real estate example that I use all the time in explaining options. And again, the purpose of this is just that real estate tends to be a little bit more tangible than talking about stocks. More people have experience with buying and selling a home. But in that example, this is a great example of how a covered call works. Now, the reason why we call it a covered call, we're going to be selling calls. We're going to be the option seller. But the reason why we call it a covered call is because we're covered in the trade. We are going to own the stock. We're going to be selling someone the right to buy the stock from us. In this case, I was the option seller, and I already owned the house. I owned that house. It was $100,000. I already own the house. So I could have owned the house. I could have bought it at $70,000 or whatever. We don't know in this example what I paid for the house, but the key is that I own the house. Okay. And what I was selling you guys in that class that we did when we first started talking about options was I was selling you the right to buy that home from me at a fixed price with a specific expiration date, and you were paying me $5,000 for that piece of paper, for that right. Okay. Now, what made this a safe transaction is not only do I get to keep this $5,000, whether you buy it or not, because remember, you have the right but not the obligation to buy the house. Whether you buy it or not, I get to keep the $5,000. If you decide to exercise your option, I have an obligation. I have to sell you the house, and I have to sell you the house at that agreed upon price. I can't change the terms of our agreement. Okay. But what makes this a safe transaction is that I already own the house. I sell you the house. I bought it maybe for $70,000. I'm forced to sell it to you. I know it's terrible. I'm forced to sell it to you at $100,000, and I get to keep the $5,000 premium that was the price of that option contract. Now you say, well, why would the option buyer want to do this? Well, we went through that example in that class. Why did you like the transaction as the option buyer? Well, because you knew the house was going to go up in value. You didn't want to tie up all your capital in buying the house and turning around and selling the house. You were able to control that movement, that price value of the house going up for a small amount of money, and you were able to sell your option contract for twice what you paid for it. You made 100% return by just trading the option contract, buying the option contract and then selling the option contract. That's what was appealing to you. What's appealing to me as an option seller here is that I own the asset. I was already going to sell it or thought about selling it. And so I basically got paid to sell my house at the price I wanted to sell it for. Okay. And if it didn't go, if that house dropped in value, if that house dropped down to 95,000 before the expiration date, then this option buyer isn't going to exercise the option. They're not going to buy the house for $100,000 when it's currently on the market for $95,000. They're not going to exercise that option. So you get to keep that premium. You get to keep that $5,000. And now, why not enter into another option contract? Let's go out another 6 months. See if somebody else wants to agree to buy the house at $100,000. I'm going to bring in another $5,000. And you could just do that over and over until somebody exercises the option and buys your house. Now you no longer have the house anymore. Okay. Now, the reason why selling calls when you don't own the house, or selling calls when you don't own the stock, let's get back to stock market stuff, is that you have unlimited risk. So let me kind of point that out here. Let's go to a stock example. Let's say that you could buy the stock at $30, and you have 100 shares of the stock. So that's $3,000 that you have tied up. And you could, let's say you could sell the 30, usually you like to go a little bit out of the money. So you let's say you could sell the $32 call, one contract, and maybe you're going out a couple weeks or something like that. Let's say it's worth 50 cents. Oops, that's not how that's supposed to be 50 cents right here. Times one contract, it equals $50. So you're bringing in $50 to do that, to sell that call. Okay. Now, $50 on $3,000, which you spent to buy the stock, is a little over, what's about a 1.6% return. And this could be over just a couple weeks. Again, that's not huge, but that's just that's additional money you're bringing in. Okay. Now, what you're obligating yourself to, though, is you're obligating yourself to sell that stock at $32. In this case, I'm obligating myself to sell the stock at a higher price than where it currently is right now. Okay. And I'm getting paid for that obligation. I'm bringing in a 1.6% return for that obligation for the next 2 weeks. Now, let's say the stock goes up to $33. I would love to be able to sell my shares at $33, but I've obligated myself to sell them at $32. Expiration date comes, I'm going to get exercised on that option. That option buyer is going to say, all right, I'm ready to buy the stock at $32. Well, I'm like, okay, that's fine. I bought it for 30. I sell my shares at 32. This is all done automatically, by the way. You don't have to do anything. It's automatically done in your account. Now I made a $2 profit on the sale of those shares, right? I bought it at 30. It was forced to sell it at 32. That's $200 I made over those 2 weeks. But I also get to keep that $50 no matter what happens. So I made $250 overall. $250 divided by my $3,000 it cost me to buy the stock is a 8.3% return over 2 weeks. Now, what if the stock only went up to $31 by expiration? Well, again, the guy that bought my $32 call is not going to exercise the call and buy the stock at 32 when it's at 31 right now. So that option is just going to expire worthless for him. I get to keep the money I brought in no matter what, so I still get to keep the $50. That option expires worthless. As soon as it expires, I no longer have the obligation. I don't have to sell my shares at 32 anymore. Maybe I go out and sell the $33 call out 2 more weeks and bring in another $50. I can just keep doing this as long as that option expires and expires worthless, and I don't have to. I don't get exercised and have to sell my stock. I can keep selling this week after week. With the weekly options, you can do it weekly. Now, weekly, the options are going to be cheaper, which means you're not bringing in as much, but you also aren't obligating yourself beyond that week. So it's kind of like the analogy a lot of people use, another real estate analogy. It's kind of like a rental property, right? You buy the house, and you're hoping that house appreciates over the years. You buy the house for $100,000. You're hoping that it appreciates over the years, and eventually you're going to be able to sell that house for $300,000 or something like that. Oops, 300,000. Now, what if you bought a property for $100,000 and you just let it sit there? Nobody's in it. It's just sitting there, and 4 or 5 years later, you sell it for $300,000 and you make a $200,000 profit. And you're bragging to all your friends, and you're saying, "Oh, I am the greatest real estate investor. I bought this house 5 years ago for $100,000. I just let it sit there empty for 5 years, and I just sold it for $300,000. Well, what are your friends going to say? They know anything about real estate. They're going to say, "Well, you're an idiot. Why didn't you put renters in there over those 5 years? Charge them $1,000 a month, or on a $100,000 house, you're probably not going to be able to rent it for $1,000 a month. But whatever your rental price is, you could have brought in so much more money. I'm not going to do the math here, but you could have brought in so much more money over those 5 years renting it out, right? That's kind of the concept of covered calls. If you're holding the stock for a longer term move, why not sell these calls and bring in extra money? Bring in that extra 1% or 1.5% a week or every 2 weeks or something like that. Now, where that analogy differs is that we are obligating ourselves with that contract. If the stock goes up to $33, I'm going to be forced to sell the stock at 32. Okay. And then what people do is, as soon as that stock dips a little bit again, they'll buy it back and they'll do the same thing. They'll sell calls. Or another way that they'll do this, and probably a better way to do it, is that that stock stair step, right? They don't go straight up. They tend to stair step. And so, you buy the stock down here at $30. It runs up to $40, let's say, and then it starts to show kind of a bearish reversal. And part of what I'm trying to teach you in all these updates is how to recognize, like today, a bullish reversal signal. It could be that the market rallies for a few days. Now, a lot of these signals are very short term. They're not necessarily going to tell you the longer term move, but you can recognize some of these short term signals, and you've got weekly options in the options market, so you don't have to obligate yourself to be right over a longer period of time. Let's say we get a bearish reversal signal when the stock's at $40. Well, let's sell the the $41 call, bring in $50 or whatever you're bringing in, however amount that is. The stock dips down here to $37 after that bearish reversal. You're holding this thing for the long term, so you don't mind these little stair steps. You know the stock's going to stair step as it's going higher. You still think it's going to higher. You think this is a temporary pullback. You bring that $50. Now you're pretty much guaranteed you're guaranteed to make that $50, but you also have a high probability that that option is going to expire worthless because you're expecting this pullback to take place. And it's the likelihood of it pulling back and moving back up again in that 1 week period is probably pretty low, although it could happen. So there's still a chance you get called out. But even if you do get called out, you bought the stock at $30. You make that $10 profit. You don't make the extra dollar profit here because, or beyond that extra dollar, you do actually make that you're selling it for 41. But if it went to 42, you don't make that anything above 41. You don't make that profit. But you made the big profit up all the way there, and you get to keep the premium no matter what happens. And then you wait for the next little pullback and you buy the stock again. Okay, but the chance if you do it like this way, your chances are you're not going to get exercise on the option. You're going to be able to keep your stock, keep the $50, pulls back a little bit, and then runs up to $50. Do it again. If it has a bearish reversal, do it again. Bring in another $50 or whatever, and you can just kind of keep adding that income as that stock continues to move high. You're making the money on the longer term move of the stock, and you're making money on the little shorter term back and forth moves that the stock is making. They're taking. Okay. Now, on Tuesday, I'm going to go through an example of this. We're going to look at when we're going through our list of 98 strength rank, these are stocks that are outperforming the market. I'll make sure that, one thing you have to be aware of too, though, is that some of these stocks that show up on the list are very small companies, and they may not even have options available on them, or the options they're very illiquid, meaning there's a big difference between the ask price and the bid price. You kind of want to tend to stay away from some of those. They can cause a few headaches. But we'll kind of apply this, and then I'll show you some other little strategies that you can use along with this. But the basic concept is this right here, that you're selling someone the right to buy the shares that you already own. Now, the risk, again, what makes this a very safe strategy is that we own the stock. Like I said, we bought that stock at $30. Now, what if we don't own the stock? Could I just go out there and sell the 32 call and bring in that 50 cents or $50? Yeah, you could do that, but you are not covered. You don't own the stock. In the term they use in the options market is you are naked. You are naked in that position. So you'd be selling a naked call. Selling a naked call is the riskiest option strategy in that you can do, and it's really not worth it to take that. It's just not worth it at all to take that risk, because the risk in selling a naked call is that you're obligating yourself to sell the stock at $32. What if overnight some news came that you just didn't know was going to happen, and it was really good news, and the stock opened up the next day at $45? You've obligated yourself to sell the stock at 32. That option is going to get exercised. That option buyer is going to go ahead and exercise that option, buy the stock at 32, because he could turn around and sell it for 45. Well, since you don't own the shares, you would have to go buy, and if it got exercised, you would have to buy the stock at $45 and then sell it to the option buyer at 32. That'd be a $13 loss. Oh, but not quite, because you get to keep that $50 no matter what happens. So you could knock out that 50 cents right there. It's only a $12.50 loss, but it's huge, and it's unlimited. I mean, look at what GameStop did when those traders got a hold of it. It went from a $5 stock to a $200 stock within 2 weeks. Imagine if you had sold the $10 call on that out 2 months, thinking that you were, and you weren't covered, you didn't own the stock. Well, first of all, your broker would have, because you're going to have margin requirements. Your broker's not going to let you not have enough in your account. Well, it could be that it jumped so far that it went beyond what you have in your account and what your broker is going to lend you, and you could be in debt for years paying back your broker because that trade went against you in a big way. So very risky, and it's not worth the return. You'd be better off buying the call where you don't have an obligation. If you get that big move, you could have a nice 1,000% gain on your option or something like that. But you wouldn't be risking more than what you paid on that option. You don't have the unlimited massive risk associated with it. Okay. Now you say, well, why then were you telling us to sell naked puts last class? You know, that they're naked, right? Well, because that's different. We were obligating ourselves to buy the stock. So when the stock was at $30, we were selling the 28 put, obligating ourselves to buy the stock at that price. Now that is a risk when you're selling puts. What if that stock were to have really bad news and it jumped all the way down to $20? You're going to get exercised, and you're going to be forced to buy that stock at 28, even though the stock is now worth 20. It reduces the risk a little bit because you brought in that premium. Maybe you brought in $1 premium or something like that. So it's only your cost basis is 27. But that's why those rules for selling puts were so important. You want to like the stock, and you want to like it at the strike price, because that's the exercise price. You want to do some homework with those trades. You don't want to be selling naked puts right before an earning announcement where you could get a really bad unexpected news where the stock tanks. All right. So in the next class, again, we're going to walk through an example, and I'm going to try to see if we can walk through an example of what we see on the scans, because that's the whole point, is to combine some of these strategies with what we're seeing with, looking for that 98 strength rank, stock going from hold to buy. And then, we could just go buy the stock, or, we could buy the stock and sell covered calls. We could sell puts to acquire the stock in the first place. We can implement some of these strategies around the system of finding these stronger companies off of the TradersPro platform. Okay. All right. Thanks, everyone. Have a great weekend. We'll see you on Tuesday, and we'll go through kind of more of a live example of this to kind of walk you through, and a couple other strategies that you can use along with it as well that are kind of cool, especially in today's environment. And if you have a broker that doesn't charge commissions or very cheap commissions on options and things like that, this strategy can work pretty well for you. All right. Thanks, everyone. Have a good weekend. Bye now.